Just starting today with our Asia session of this 12-hour forum, of course, going around the globe and working our way all the way to America at the end of this day. We've just had a couple of feature interviews to kick off the Asia session. I hope some of you who are tuning in today have had a chance to hear that, to set the scene for us, really, because on this panel, we'll be talking about China's macro economic outlook and oil demand growth for 2025. And I'm delighted to be joined by Victor Yang, Senior Analyst at JLC Network Technology, Clyde Russell, Asia Commodities and Energy Columnist at Thomson Reuters, and Chong, Independent Energy Analyst. Gentlemen, thanks so much for joining us today for an outlook on the year ahead for China and how that's going to impact oil demand.
Thank you.
Great to have you with us. Clyde, let me start perhaps with you, and let's have a bit of a macro outlook. I mean, we just had a couple of comments in the earlier sessions, and China again looking and saying it's looking towards a sort of now the new sort of 5% safe GDP growth figure that's being touted as the new, I suppose, average for the last year or two and years ahead. Of course, a lot of activity by the Chinese government in the last year on stimulus, most recently changing even its monetary policy on interest rates, etc. And we've seen the impact that has had on oil demand in the last year. But let's look ahead, Clyde, and get your view on, if this 5%, if it actually materializes, will hold energy demand steady for the year ahead for producers in particular.
Well, I think the first thing we have to do is say the 5% is just the best guess, what we hope for. There is just one massive, huge elephant in the room. It's Donald Trump. Almost everything we talk about is going to be subject to what Trump does. So we have to make a few assumptions. If you're going to say China's going to get to 5% growth in 25, we're going to have to assume that whatever Trump does is not actually that bad for the global economy. He doesn't launch a full-out trade war. There's no 60% tariffs. We have to assume that, we get a sort of what would pass for a normal version of Trump rather than, Trump on steroids. So with those caveats, I think it's quite possible that you could see 5% growth in China. But I think you've got to look at the composition of that growth. It's quite clear that they're putting quite a lot of effort into stimulating the manufacturing, particularly their new energy type manufacturing. So new energy vehicles, solar panels, that sort of thing, that sort of technology, batteries. They're still struggling a bit with the housing construction. And there are sort of, their economy is not, it used to be when China had a strong growth year, all sectors were pulling like steam trains. Now that's not really the case. So I think if you're actually looking at the sectors that I see doing best in China would be the ones that tend not to be drivers of oil consumption. So if you're looking at things, I think it's quite clear that their switch to electric vehicles is unstoppable, and it's an area where China's built up such a huge advantage over the rest of the world. Sales up 35% of new energy vehicles in the first 11 months of last year. It's just an unstoppable thing. That was actually very bad for crude oil demand because less gasoline is needed. You're also looking at LNG trucks have taken a large share of the market for new trucks in China. That's hurting diesel demand. Is that a trend that's likely to continue? Yes, because I don't see the price of LNG accelerating too high, and I think it's still competitive with diesel. So, if I look at it, our sort of figures that we have suggest that China's oil demand dropped. I mean, China's oil imports, not its demand. Its imports dropped by about 200,000 barrels a day last year. It's hard to see that rebounding on what we currently are expecting to happen in China.
Okay, thanks, Clyde. Well, Victor, let me go to you with those comments from Clyde, pretty bearish in terms of import future going forward. We just had a comment on the feature interview also earlier saying that, again, this people in agreement that gasoline and diesel demand may be peaking in China. What's your outlook sitting there in China on the consumption trends going forward for 2025? Do they look stronger or weaker than we've seen at least in the past year?
Well, first, I would like to say Clyde knows a lot about China and what's going on in China. Yes. As he says, well, the country's economic growth now relies a lot on new energy, NEVs, high-tech industries, unlike in the past, a lot or mostly on energy, high energy consuming industries such as the steel industries, housing, and so on. So it's now transitioning its focus on the drivers for economic growth. So as Clyde says, it's bad for crude oil demand. So for now, the linkage between the country's economic growth and its oil demand is weakening year by year. Say, when we look at 5% of growth for 2025, we do not expect to see as strong support for crude as in the past when the country posts 5% growth. That's quite different for now. But at the same time, China's demand is still large. I mean, taking a large share among global consumption. For instance, now its imports is still over 11 million barrels per day on average, and that's quite large compared with global consumption. And for 2025, the big thing is there's still expectation of growing demand. And Sabbagh is even more optimistic than PetroChina. It expects relatively large growth for 2025 compared to PetroChina's. And now the focus is on the transition to chemicals. A lot of refineries have now upgraded their refinery to produce more chemicals and special products. And in that case, this would become the new driver for oil demand in 2025 and the coming years too.
Well, thanks, Victor. Jan, welcome again. Okay, well, let's talk a bit about the other side of the coin. You know, with this sort of, I mean, again, we're talking about 2025. These trends are clearly are what they are going forward. But do you have the same feeling that we're going to see these impacts today in the year ahead, or are we talking about in 5 years' time, this sort of shift to EVs, the shift in economic policy impacting China's oil imports? And let me ask you, maybe from the angle of the oil producers who are supplying China today, how are they looking at this sort of quite significant shift in China's consumption patterns?
No, it's not going to be sudden, right? It's going to be gradual, right? And China they have published a plan that by 2030 they will stop expanding refining capacity, right? But between now and then, it's going to be gradual. And I mean, put it this way: they issued a second import quota, and the total import quota this year is now at almost 199 million barrels a day. 199 million tons, right? That's already more than last year's 183 million tons. And that was a new refinery that came up in September, the Yulong refinery, that is expected to be running full during sometime this year, right? So that's a 400,000 barrel a day refinery. And what Victor said is correct, because all these new refineries today go from crude to petchem, right? So well, diesel and gasoline demand may drop, but they would anticipate that petchem demand to grow and to stay healthy as the years go by, right? I mean, China is the world's largest factory, or still is, right, and still wants to be, and that is where all the petchem demands are going to, right? So if you look at the big private Chinese refiners that are around, Rongsheng has an 800,000 barrels per day refinery. The Saudis invested 3.4 billion to get a 10% stake into this refinery, right? And what is 10% for 3.4 billion? That's a lot of money. Are you saying that the refinery is worth 34 billion? Why did the Saudis do it, right? The checker behind that is that the Saudis wanted to secure an outlet for their crude, right, from a supplier perspective. And they also see long-term that crude demand is going to drop because the whole world is going EV, etc., right? Crude, essentially, the primary purpose for oil is transportation, right? Whether sea, land, air. And that is all moving away from oil between 2040 and onwards, right? So the Saudis still have a lot of reserve, and they produce a lot of crude, and they want to secure their outlet. And this deal with Rongsheng basically the other part of the deal is that they only take the crude from the Saudis, right? So, and I would see the Saudis going forward doing more of such deals with China, with India possibly going forward, right? But where are the new refineries coming up in the world? Nowhere else but China, right?
Yeah. Okay, thanks. So, I mean, the refinery expansion in China still obviously lending significant support, and the petchem shift, of course, that's been happening, and not only in China, of course. Clyde, back to you. You mentioned at the top of the sort of hour, it depends. What if Trump goes ahead with his 60% tariffs, then it's really doom and gloom for China. Let's not speculate too much on whether he will or he won't. It could be more rhetoric than action. But either way, China's clearly been thinking and prepping, its response, whether it's 30%, 40%, 50% tariffs. Do you think it has been prepping? I mean, are the signals that it is ready for that? What could it do in response in terms of how that might impact its energy security goals, in terms of oil price, in terms of whatever it might do, in terms of the impact of tariffs on its exports, obviously, elsewhere? How well prepared do you think China is this time around? Is it probably in a stronger position as it can predict what might happen?
Well, their economy certainly isn't in a stronger position. So I think a lot of their planning will have been around how to mitigate the damage to their economy. I think what they'll do is they will be what I would describe as very cool customers. So they're not going to try and rile Trump up. They're not going to impose retaliatory tariffs. If China wants to do retaliatory tariffs or retaliatory trade measures, they just simply tell people to stop buying American products, much like they told everybody to stop buying Australian coal a few years back. There was no formal ban on Australian coal, but it disappeared from China anyway. So the Chinese have various levers that they can pull to do this. I think what they've clearly identified is that they have this massive comparative advantage of the rest of the world in a whole range of things, most of them related to the energy transition. And I think they're looking at leveraging that. But your question is always, can you actually sell more EVs to the rest of the world, particularly into what you might term the global south? And will that be enough to compensate for the loss of manufactured good exports to the US? We're assuming that there is going to be some level of tariff. I think Trump has made it clear that he wants something. He has to deliver some form of tariff against China to have any credibility amongst his own base. So I think we're going to see something. Can the Chinese actually sort of keep the temperature dial down, redirect as much of their economy away from away from America, and sort of survive? I think that's kind of what they'll be planning. Of course, if things get really bad, then they've got a whole range of other levers that they can pull. They could sell US treasuries. They could hurt America in many ways that probably Trump isn't actually thinking about. But my base case is that they'll try to mitigate and keep everything as calm as possible, and actually, for a change, be seen as the good guys of world trade rather than the bad guy. So that's what I think is most likely to happen.
Okay, thanks, Clyde. Victor, I mean, let's talk a bit about that. But you were mentioning also the EVs and how the economy is obviously changing its direction. Again, it's going to be a gradual shift. But I'd like to ask you about also just your opinion on the sort of the stimulus that we've had in the last year. Going forward, we've had also more emphasis on the changing in their sort of monetary policy in terms of what they're going to do with interest rates, their directions to banks. Principally, as I understand it, the changes before, the government would direct the banks on how much they can lend, basically the volume of credit. And now they're going to be setting the price of the interest rate and then leaving the banks to decide what that means in terms of, putting money out there as credit into the economy. Do you think, in your opinion, is this shift going to work in terms of principally stimulating consumer confidence back into the economy?
Yes, well, and first of all, we expect larger stimulus in 2025. For instance, in 2024, the government supply and provide the trading of a lot of products such as cars, electric appliances, home appliances. And now it has announced that this will be continuing in 2025 and expanding to more products too. But the specific volume, I mean, the specific amount will not be announced yet until probably March. And a lot of other measures too, such as, well, the interest cut, as you mentioned. So basically, we are expecting more stimulus for 2025. And consumer spending, well, I mean, the confidence in this one is gradually coming back towards the end of this year, particularly in the last quarter of 2024, after China will provide large subsidies on the trending a lot of products, such as the car sales in the last quarter. We saw a significant jump. And this will be continuing in 2025 too. But on the whole, it will take some time for the conventional industry to come back fully. Yeah, and the country needs to prepare for even more tariffs from the United States. And it has said a few times that there will be a lot of challenges in 2022, 2025 too. Yeah.
Yeah, I mean, well, it's preparing for the tariff policy. And of course, one way to defend against that is to weaken its own currency to help its exports.
Yes.
And we did see actually the one hit a 16-month low this week. Do you think that's, I mean, how does that fit in with them also trying to reinflate, you know, their economy? I mean, they seem to be stuck a little bit, Victor, in terms of what they need to achieve. How worrisome is a weakening currency for them? It may help their trade, but what about on the domestic front?
Well, when we look at the weakening currency, well, is to help export. But on the other hand, it will damage imports. So the country will not let the weaken appreciate a lot. Well, we do not expect very large drop in the yen in 2025. Maybe yes, it can be weakened a little bit further in 2025, but well, not probably a jump. And this will, for instance, it will impact the imports of crude and other energy bulk commodities too, as the prices go up. Yeah. So it needs to strike a balance between these imports and exports too.
Yeah, yeah. Thanks, Victor. Jan, I mean, let's talk a bit about oil price, because of course we saw last year an average of about $80 for Brent. The outlook this year ahead is weaker as an average price. If you take a lot of opinions into account, that's good for China, isn't it? And you mentioned its import quotas, that it's set higher ones this year. How much would a lower oil price, let's say we average 70 to 75 in the year ahead, for the sake of argument, how will that impact its strategic petroleum reserve policy, do you think? Will it, as it has before, take advantage of, you know, lower prices when the time is right?
Well, I mean, put it this way, they have always taken advantage of lower prices as and when it occurs, right? And this is mainly the independents, right? The other factor is that the independents, especially those who do not have crude import quota, actually import fuel oil as a feedstock. And the tariff for fuel oil has gone up for this year by about 3% or so. So this would probably push them into taking more crude, right? So lower prices would be even better for these guys. I mean, as of now, the refining margins for the private refiners, the smaller guys, they're not fantastic, right?
Yeah.
So they have been cutting runs and, you know, keeping the runs low, just barely keeping it going, right? And the long-term outlook for the product market, we don't see the product market strengthening anytime soon. Diesel particularly is not great. I mean, margins have been in the region of $15-16 a barrel, and this is but it's gone back to what we would call pre-COVID levels, pre-COVID normal levels, when there was an overcapacity of refining capacity. Remember those days when the Saudis refining capacity increased, there was some capacity increase in China, etc. So we've gone past the strong margins of the post-Russian invasion of Ukraine, and now the margins have gone back to normal. And demand has been demand for diesel has been lackluster, right? And we do not, even we are in the midst of the winter, demand for diesel has not gone up, or heating oil has not gone up. Europe is not really importing a lot. So, and we are coming out of the winter, so we are coming into the off-peak season for diesel, right? Gasoline, on the other hand, has strengthened a little bit. We are looking at, and this traditionally, the gasoline will strengthen around Q1 ahead of the driving season. So that may prove a little bit of relief, but it's not enough for these guys. Yeah. So
okay.
Yeah, lower flat prices would certainly be most welcome, for sure. In fact, I am looking at, given the state of the global economy, maybe even below 70, right? I mean, look at it this way. OPEC Plus keeps postponing the decision to remove the production cuts, right? And now we have production cuts until Q2, right? I mean, I don't see things improving by the end of Q1. Yeah. What are they going to do going forward after that, right? They can't keep postponing that decision as well, right? Because I do think that there are the smaller OPEC Plus members do want to increase their production, especially if flat prices are falling and the margins are shrinking, right? And they would want more volume to compensate for the lack of margin.
Of course. Yeah, thanks, Jan. Well, I wanted to go to Clyde about OPEC and but focus in on the big producers there. Saudi, for example, the UAE even. I mean, and from a China point of view, Clyde, again, coming back to the question of how should producers be looking at China's economic outlook, especially those in the Gulf oil producers who, of course, that is a major client of theirs. We've seen OPEC policy, as Jan just mentioned, but continue to keep the volumes off the market for obvious reasons. We won't get into that. One of them has been China demand, but global demand in general. Clyde, should big producers be concerned about the outlook for China? How will they adjust their export policies, if at all, going forward? How should they be looking at that any differently from what they have been?
Well, I think the key point is they definitely got China wrong last year. I mean, if you actually look at it, they were talking that China is going to lead world demand. You had, as recently as July, OPEC forecasting China demand to go up 760,000 barrels in 24. That was not just wrong. It was, let's be frank, let's be honest, it was hopelessly wrong. That just didn't happen at all. So, they were really caught, I think, by surprise by the rapid shift to EVs and the rapid shift to LNG and trucks. And those are trends that are going to continue because this is China's comparative advantage. They've made it quite clear that they actually would prefer to electrify their vehicles and and use renewable energy in their grid and even coal. From their perspective, using their domestic coal and cheap imported coal, because the coal price is quite weak, is actually a much better deal from them than importing crude. And they know that. So I think there has to be a sort of structural shift in OPEC, and you started to see that coming through, and they've been talking about what Victor was talking about, the switch to petrochemicals. I'm skeptical because I can't really see how petrochemical demand is going to rise so strongly in order to offset lower diesel and gasoline. Yes, I also expect we'll get higher aviation fuel demand and things like that. But in reality, it seems that the loss from the sort of diesel and gasoline is going to be way more than the gain from petrochemicals. Unless China is really planning on exporting a hell of a lot of petrochemicals into the global market, I just don't see how petrochemicals can get that big that quickly. That aside,
please carry on. Yes.
Yeah, I was just going to wrap it up by sort of saying, OPEC has the sensible thing in some ways would be to try and stoke demand by lowering prices. That would not just work in China, that would work everywhere. But at the same time, they've made it quite clear they don't want the price to go below $70. So if their price stays above $70 a barrel, they incentivize an even more rapid switch to EVs, but they're unwilling to let it drop below. So they've painted themselves into a sort of a corner, and I'm not really sure how they're going to resolve that. At the moment, their policy is just kick the can down the road.
Yeah, and except perhaps we're going to have a lower price range going forward, and accept that and adjust their budgets accordingly. Of course, that impacts some producers much more than others. Saudi arguably can afford below $80, below $70 even. Others can't. Thanks, Clyde. There's our survey question for the panel, which is, what's the most likely outcome of China's projected 5% economic growth on energy markets? Of course, assuming it will be 5%, and that remains to be seen. If we do get that 5%, will it mean increased oil demand, supporting higher prices, stable oil demand, maintaining the current dynamics, and weakened oil demand, disrupting global markets? Is the world adjusting to this more or less 5% or not? So we'll see what the result of that is. Victor, let me go back to you. I mean, we've obviously had clear consensus here on the new trends in Chinese energy demand, whether it's going to kick in this year immediately or in the next 3-4 years. Let's talk a bit about China's domestic production policy, if you like, refined products, if you like, and it's the exports into the region, in terms of the prospects there in the year ahead for China, taking into account demand in the rest of Asia, and also margins elsewhere for refiners. How positive is that looking? We've touched on import quotas. Let's talk about export. We've touched on the export quotas, but let's look at a bit more concisely as to what that outlook is for China. Does it have any hope where it can pin that it'll have good demand for its products, given the economic outlook for the region?
Well, for refined product export, we do not expect significant growth in 2025. And the country's policy is to reduce its dependence on crude imports and then cut its exports of refined products. And in December 2024, it cut the value-added tax rebate for the export of a large range of products, including gasoline and diesel. And Chinese companies had got their applications for the quotas on general trade export of gasoline and diesel because their margins had dropped because of the cut in tax rebate. And over the long term, the country's policy is to reduce export and focus more on domestic consumption. So in the future, domestic consumption will be increasingly important for the country's imports and its oil demand. And take the first batch of 2025 export quotas, for instance. The quotas for gasoline, diesel, and jet fuel in combination were stable on a year-on-year comparison. But the quotas on processing trade grew, and those on general trade declined because of less margins. So, as Clyde said, he was a bit skeptical about whether petrochemical production can make up for their loss in gasoline and jet fuel and diesel demand. And on the whole, when we look at demand for gasoline and diesel in 2024, we saw a significant drop in diesel demand, but not in gasoline demand yet. For instance, PetroChina and Sabbagh reported divergent gasoline and diesel sales, and on the whole, we still see a slight increase in gasoline demand in 2024. So, to some degree, petrochemicals can make up for some losses of the fuel demand, mostly for diesel demand. And we do not expect such a drop in diesel demand in 2025 either, as the industry tends to stabilize. Instead, the plunging in 2024, yes, that would be quite different.
Okay, thank you, Victor. Well, we're going to wrap up our session there. Thanks so much to Victor Yang and Clyde Russell and Yang Chong. We have our survey result there. Majority voting stable oil demand, maintaining current, steady as she goes. A more bearish outlook for the global economy probably going forward this year. And we'll see how that impacts, of course, China dynamics and Trump in a week or so. cementing his real position in power. Let's see where that all goes. Thank you so much, gentlemen, for joining us, and we look forward to you hopefully joining and listening on the remainder of the sessions. Thanks.